We have crossed a line that cannot be uncrossed. For years, a small group of analysts, traders, and long-term metal holders warned that the silver market was no longer functioning as a real market. We said the pricing mechanism was distorted. We said the selling pressure wasn't natural. We said the structure depended on leverage, paper promises, and confidence that would eventually fail. Most people ignored it. They laughed. They dismissed it. They called it conspiracy, fear-mongering, or just another doomsday narrative that never quite arrived. Until now. Because today, Saturday, December 27th, that system finally snapped. Not bent, not cracked. It collapsed. As of the electronic close, silver is trading at $79. 25 per ounce, up $7. 34 in a single session. That is a 21% move in one day. Let's be absolutely clear about what that means. This is not a rally. This is not enthusiasm. This is not healthy price discovery. Commodities do not move 10% in a day under normal conditions. When you see a move like this, you are not watching buyers step in. You are watching someone being forced out. You are watching a liquidation cascade. You are looking at the aftermath of a financial implosion. This is what a crime scene looks like in markets. Somewhere, right now, a massive short position has been erased from existence. A fund, a trading house, possibly a bank. They didn't choose to exit. They were dragged out, contract by contract, at whatever price the market demanded. They weren't negotiating. They weren't analyzing charts. They weren't optimizing entries. They were hitting the buy button until there was nothing left to buy and no money left to spend. And because this happened during the thinnest liquidity window of the entire year, the dead zone between Christmas and New Year's, the price didn't climb. It teleported. Vertical moves don't happen when markets are calm. They happen when markets break. And now, silver is knocking on the door of $80. In this emergency breakdown, we're going to dismantle exactly what just happened, step by step. We're going to explain why this was inevitable, why it's not over, and why the consequences extend far beyond silver itself. We'll look at gold, now trading above $4,500, and why that level confirms something much bigger, a real-time breakdown in confidence in fiat currency. We'll also prepare you for what comes next. Because if silver finishes the week anywhere near these levels, the Sunday night open could trigger exchange limits that freeze global trading. The rules have changed, the system has lost control, and the panic phase is only beginning. Why a 10% move is never just a move. To understand the violence of what just happened, you have to understand how markets normally function. In a healthy market, prices are discovered through negotiation. Buyers place bids, sellers place offers. Price moves when those two sides meet. But during forced liquidation, that process disappears. When a leveraged short position collapses, the clearing system takes control. The algorithm does not care about price. It does not care about valuation, indicators, or sentiment. It has one command: close everything immediately. That means buying at any cost. It consumes every sell order in the book. It doesn't pause. It doesn't wait. It doesn't ask whether the price makes sense. That vertical line you saw on the chart today, that is not excitement. That is the footprint of a whale dying. The speed was instantaneous. The volume was enormous. The price impact was extreme. This is confirmation that the silver short squeeze is no longer theoretical. It is no longer a risk scenario. It is happening. The sequence is always the same. Retail shorts fail first, then small funds, then family offices, then institutional players. Eventually, the stress reaches the systemically important players, the bullion banks themselves. And when silver moves 10% in a day, you are not watching supply and demand for a metal. You are watching confidence evaporate in the currency used to price it. This is capital fleeing paper. Gold just confirmed everything. Now zoom out. Silver doesn't move in isolation. It has a big brother, and that brother just spoke very clearly. Gold is now trading at 4,434, up over 1% on the day. That number matters. For decades, economists, strategists, and central bank apologists said $4,500 gold was impossible. They said it represented systemic failure. They said it was a doomsday scenario. Well, here we are. Gold holding above $4,500 is not noise. It is validation. It confirms that silver's explosion is not a fluke. Historically, gold and silver move together, with a long-term ratio averaging roughly 15:1. That means that if gold is priced at $4,500, silver's implied value is closer to $300 per ounce. At $79, silver isn't expensive. It's late. It's behind. And that gap is exactly what the algorithms are targeting. Quant systems look at gold at all-time highs, then they look at silver still dramatically below its inflation-adjusted peak, and they buy, aggressively. Billions of dollars rotate into the only major monetary metal that hasn't fully repriced to the new reality. This is not fear buying. This is mathematical catch-up, and that trade is powerful. Why the vertical move is only the beginning. People are uncomfortable with charts that go straight up because they've been trained to expect suppression, grind, and control. But liberation is chaotic. Silver has been held underwater for decades. When pressure finally escapes, it doesn't drift upward. It explodes. And now we face the weekend problem. The market is closed. Price is frozen at $79.25, but the information cycle is not frozen. Headlines are spreading. Rumors are circulating. Whispers of bank stress, hedge fund failures, and settlement issues are growing louder, especially in London. This creates a psychological pressure cooker. Anyone holding paper exposure is now questioning everything. Will the exchange open? Will their broker survive? Will contracts settle? That fear doesn't stay in the system. It exits the system into physical metal. This is why bullion dealers are suddenly sold out, offline, or call for pricing. They are not doing maintenance. They cannot price inventory fast enough to keep up with reality. If you try to buy physical silver right now, you're not paying $79. You're paying whatever the street demands, and increasingly, that number has already crossed into triple digits. This disconnect between official price and real-world price is the hallmark of a currency crisis. When goods cannot be obtained at the quoted price, the price is fiction. The limit-up scenario no one is ready for. Now we need to talk about Sunday night. The CME has circuit breakers. If silver rises beyond a certain threshold in a single session, trading halts, no buying, no selling. The screen freezes. With silver already near $80, a modest gap higher at the open could hit that limit almost instantly. What happens then? Panic. Imagine being short. You're losing millions. You want out, but you can't trade. You're trapped while the building burns. And when trading resumes, it often reopens higher. This is how markets lock limit up for days at a time. We've seen it before, in nickel and lumber and other stressed commodities. If silver halts on Sunday night, it is not bearish. It is confirmation that demand has overwhelmed the exchange's ability to function. That volatility afterward will be brutal. $10 swings in an hour will become normal. This is not a market for leverage. This is a market for ownership. The January wall of money. Now layer in the calendar. January is when institutions deploy capital. Funds that plan to buy silver at $65 or $70 are now staring at $79 and realizing they waited too long. History tells us what happens next. They chase. Institutional investors do not fade momentum. They follow it. A 10% daily move does not scare them. It attracts them. It signals performance. So when January the 2nd arrives, a wave of fresh capital will hit a market that is already structurally broken. This 10% move was not the earthquake. It was the foreshock. Expect turbulence, not failure. Let's be realistic. No asset moves vertically forever without violent corrections. After a day like this, we could absolutely see profit-taking. Traders who bought at $60 or $65 may lock in gains. A pullback to $75 would not invalidate anything. It would be normal. In a vertical market, a $5 drop is not a crash. It's a reset. And every dip becomes fuel for buyers who missed the breakout. The trend is intact. The supply is constrained. The structure is broken. When price moves before the news, one of the most important signals in markets is movement without explanation. When an asset jumps 10% without a headline, it usually means the headline hasn't hit yet. Someone knows something. Maybe it's a bank failure. Maybe it's a geopolitical shock. Maybe it's an export restriction. We don't know yet, but price does. This is why professionals follow price, not press releases. By the time the news is public, silver will already be higher. What you should do right now. Your job this weekend is not to panic. It's to prepare. Audit your exposure. Understand what you actually own. If your silver is unallocated, reconsider. If it's in an ETF, read the prospectus carefully. Counterparty risk matters now. This is the calm before the next surge. The casualty problem. No one wants to name. A 10% move in silver doesn't just create winners, it creates losers, and very large ones. Retail traders cannot absorb a $7 move. The shorts who lost today were institutions with balance sheets measured in billions, and rumors are already circulating that at least one clearing member failed a margin call. If a clearing member defaults, the exchange itself is forced to intervene. Losses spill into the default fund. Other banks are pulled in. This is contagion, and contagion spreads fast. Industry is panic hoarding. Now look at the industrial side. If you run a major manufacturer and silver jumps 10% in a day, your biggest fear is not price. It's availability. Suppliers stop shipping. Refiners go silent. Contracts are suddenly under review. Force majeure clauses get invoked. That forces industrial users into the spot market, competing directly with investors. This is when shortages turn into stampedes. The physical market is seizing dealers. Pulling prices is not normal. It happens when inventory is critical and volatility is unmanageable. You don't remove pricing if you're comfortable. You do it when every ounce matters. From mine to mint to market, the gears are grinding. Silver is now outrunning gold. On purpose. Silver outperforming gold by 10 to 1 is not random. This is what happens in the manic phase of precious metal bull markets. The gold to silver ratio is collapsing, and that attracts another class of traders who specialize in ratio compression. They sell gold, they buy silver, more pressure, more acceleration. At historic ratios, silver's price is still far higher than today. Do not short. This market. Shorting a parabolic monetary asset during a currency crisis is financial suicide. The market can stay irrational longer than your account can survive. Buying physical? That's ownership. Buying leveraged paper? That's exposure to chaos. Volatility will destroy margin traders. Asia opens first, and that matters. When Asia opens, they will see the US move, and history suggests they will not sell. They will buy, aggressively. If Shanghai opens higher, New York will gap again. We are shifting from intraday trading to gap trading. Price discovery is happening when markets are closed. That's institutional behavior. Political attention will only add fuel if silver pushes toward $100. Governments will notice. They may blame speculators. They may threaten intervention. But political attention is not bearish. It is confirmation of shortage. This is a macro rotation. Capital is leaving paper assets and entering hard assets. This is not a trade. It is a cycle. And cycles like this last years. Final strategy for Sunday night. Expect a gap. Expect halts. Expect volatility that feels unreal. Ignore the noise. Protect what you own. And understand this, $79 was not the top. It was the door. The suppression era is over. Price discovery has begun. And once it starts, it does not politely stop. Get rest. Next week changes everything.